Today, in this video, I'm analyzing companies like TCS, Infosys, Wipro, HCL Tech, and Tech Mahindra. The results are up to date till June 2019. These are large cap IT software companies. Let us look at their ratios to understand the health of the company. The current market price of each of these companies is given in green. TCS is currently available at 2154, but its face value is 1, so there is a split in the shares. So we have to equalize to compare each of these companies against each other. So we equalize it with 10. So the current rate or price of TCS should have been 21,540 rupees. Because of the split to 1, the current price is 2,154. Infosys adjusted price is 1,640 rupees. Wipro is 1,241. HCL Tech is available at 5,200 rupees. And Tech Mahindra is available at 1,400 rupees. So after we adjust it with the split, or we round it off to a face value of 10, the most expensive is TCS, available at 21,000, and HCL Tech available at 5,200. Next, let us look at the fall in prices of these companies from 1 year back or from 52 weeks earlier. TCS has fallen 6% from where it was 1 year back. 1 year back it was trading at 2,200 rupees and currently it is available at 2,154. Infosys has fallen 3%. Wipro and Tech Mahindra both have fallen the most at 18% and 17%. HCL Tech has fallen 11%. The fall does create an opportunity to buy into the shares of these companies, provided all ratios that we are analyzing are in their proper order or below the benchmark or within the benchmark that we have set for each ratio. Next, let us look at the earnings yield per share, that is, what was the profit earned on the current share price by these companies. It is just like giving your money to a bank and what is the return or interest that they are giving you on that money. TCS current price was 2,154 and the earnings per share of 2019 was 85 rupees. So basically, to buy this share by paying 2,154, we're getting a profit of 85 rupees on that share, or the company is earning a profit of 85 rupees on a share worth 2,154 rupees. So that is an earnings yield of 4%. Infosys yield is 4.4%. The highest earnings yield was by Tech Mahindra because the price was at 703 rupees and the company's EPS per share was 49.3 rupees. So the higher the yield, the better it is. If you give your money to the bank, you expect at least 6% yield or returns on the money that you're given to the bank. Similar is the case for companies. Although some companies would provide less, some companies would provide more. Next, let us look at the price to earnings ratio or PE ratio. This ratio helps us understand how far away the price is compared to the earnings of the company, or how many times more we are paying for the earnings of the latest year. TCS earnings per share was 85 rupees and the price of the share was 2154. That is, it was available 25 times more than the earnings managed by the company on per share basis. Infosys was available at 22 times its earnings per share at a price of 820 rupees. Wipro was available at 16.2 times. HCL Tech was available at 14.5 times. And Tech Mahindra was available at 15.6 times. So here we don't want to pay more than 25 times the earnings per share. The lower the better, as that indicates that we are paying less for the profits that the company has generated for each share. Next, let us compare the price we paid for the earnings of the latest year or of the 12 months against its historical price earning of 5 years and average historical 3 years price earning. This would help us understand where the price earning has been through last 5 and through last 3 years. TCS current price earning we paid in the last chart was 25.1 times the earnings. Since last 5 years on average, the price has been trading 23 times higher than the earnings of the company. So it has been, the current price earning is very nearby to its 5 years average as well as its 3 years average of 21 times. This would help us understand whether the current price earning we are paying is justified. Infosys is available at 22.5 times the current price earning of the 12 months against its averages of 5 and 3 years. So it is slightly above its 5 and 3 years average. Wipro is trading at 16.2 times and above its 3 years average price earning of 15.8 times. HCL Tech is available below or trading at a discount to its averages of both 5 and 3 years. Tech Mahindra is available at 15.6 times and below its 5 years average. This would again indicate an opportunity to buy whenever the price earning multiple goes below their 5 and 3 years average. Again, the caveat is that all ratios that we are looking for should be within our benchmark or our comfort zone. Only a mismatch creates an opportunity when there is a problem in the overall sector of that company which it is based, and at that time we can buy into these companies gradually. Next, let us look at the earnings that these companies have made on per share basis and how much of this earnings has been actually received in cash by looking at the cash flow from operations or CFO, and out of that CFO how much has or is left over as free cash flow to be used in financing activity. The balance between the CFO and the free cash flow will be in the investing in buying of assets. So the questions that we have to ask in this particular chart is, has the net profit got converted into cash, or has the earnings actually got converted or translated into cash? and how much of this cash that has been received from operating activity was used to buy assets, and what was left over as free cash flow to be used in financing activity. This is per share based analysis. TCS profits that the company showed for each share was 85 rupees. Out of that, company has managed to convert 76 rupees into cash, and of that 76 rupees, 70 rupees is still left over to be used in financing activity like doing buyback, bonus, acquisition, and so on. So here what we are trying to look at is whether the company is managing to convert its entire profit that it has shown into cash. In this case, the company has received less cash than the profit it has indicated. So it is a negative, although most of it has been converted into cash, some of it is still left over. Out of that cash, 70 rupees is still left over as free. So the balance of the two, somewhere approximately around 6 rupees, was invested per share in buying of assets. So this is good. Again, we don't want the cash the company has been earning to be used maximum, that is more than 50%, to be used in buying of assets, as that would keep very less amount to be used in the financing activity, like as I mentioned earlier, and also paying off debt if it is required. Infosys profit per share was 36 rupees. Of that, 34 has got converted into cash and 29 is still left over as free cash flow. Wipro's profits were 15 rupees per share. Of that, 19 rupees has come in through cash from operating activity. Now let me explain the CFO or operating activity. This is the cash inflows and cash going out and cash coming in from the business activity or operating activity of the business. So business is divided into three parts. One is cash inflows and cash outflows from the operating activity of the business. The second is the cash inflows and outflows out of the investing activity, that is buying assets or investing in mutual funds and so on. And the third is the cash inflows and outflows out of the financing activity of the business, which I already explained earlier. So we want that entire profit should be converted or translated into cash. That is, if the company is showing 15 rupees as profit, has the company received that 15 rupees in cash? Now the reason why Wipro has received more cash is through operating activity, is because most of the expenses that had been shown in the profit and loss account as expenses like depreciation has to be written back when calculating the cash flow from operations, because the profit that was reduced in calculating the P&L account, in that no cash had gone out as such in the depreciation expenses that were shown. Out of that 19 rupees received in cash, 15 rupees is still left over as free cash flow. So most of these companies' free cash flow is at a very good level compared to its cash earned through the operating activity. HCL Tech's profit was 72 rupees and CFO was 66. Again, slightly less than the profit that the company indicated, and out of that 66 rupees of cash, 40 is left over as free cash flow. So this is also good. Tech Mahindra is a similar case. Its profit per share was 49 rupees and the cash earned through operations was 45 rupees and the free cash flow was 37.9 rupee. So most of these companies free cash flow is at a very good level. Again, as I mentioned, the free cash flow should not fall 50% of the cash it has earned through operations. For example, if the company has earned a cash from operations of 66 rupees, the free cash flow should not fall below 33 rupees. This is my benchmark. Investors can select or create their own benchmark depending on their comfort zone or depending on what are their criterias. Some growth companies may use up all of the cash, so that is also all right, provided there is proper returns being generated on that investment that the company is doing in buying of assets. Other than that, what I feel is if the company is investing a huge portion of its cash earned through operations in buying of fixed assets, are those assets generating a higher return for the company? So that has to be seen. Whenever company invests a high portion of its cash in investing activity or in buying of assets, it basically leaves a very less cash for the financing activity. If the companies have debt, then they have to repay or do a repayment of those debt. And if the company wants to acquire another company or provide dividend or do a buyback, then it wouldn't have a free cash flow to do that. So there has to be a balance maintained between how much the company is using cash in buying of assets and how much it is leaving it over as free cash flow. Next, let us look at where the current market price is compared to the cash earned through operating activity. The question we have to ask is how many times more we are going to pay for the cash flows from operations of the latest year. This ratio is a total ratio, meaning here I have not considered per share based values. TCS entire market cap is 8,08,000 crores. This is the value given by the market participants to the company in the share market. Against this price of the company has earned a cash in 2019 of 28,591 crores. That is, we will be paying 28 times more for this profit to buy this company. Even if we consider the per share based value, this 28.3 wouldn't change. We are still paying 28.3 times more for the profit the company generated. Infosys was available at 23.6 times its OCF. Earlier, we looked at the price and the earning ratio. In that ratio, we were looking at the profit the company generated on the price or on the market cap. Similarly, we are here in this particular ratio, we are looking at the cash generated and what was the company's market price. Here too, we don't want to pay more than 25 times the cash generated by the company. Wipro was available at 12 times HCL Tech was available at 16 times its OCF, and Tech Mahindra was available at 15.3 times the OCF. So here we want to pay as less as possible. So the lower we pay, the better our chances of earning a higher gain or higher profit from these companies' shares. Next valuation ratio is the current market price compared to the free cash flow. That is how far away the price is or the market cap is compared to the free cash flow the companies have. Here too, we don't want to pay more than 25 times the free cash flow. As I mentioned, these are my benchmark. Investors can tweak this benchmark up or down depending on their levels or their comfort zone. TCS was available at 30 times its free cash flow. The company's cash flows were 26,457 crores, against which the company's market cap was 8,08,000 crores. So that is 30 times more than the free cash flow. Infosys was available at 28 times its free cash flow. Wipro was available at 15 times its free cash flow, and HCL Tech was available at 25 times its free cash flow. Tech Mahindra's price to free cash flow was 18.6 times. So Wipro and Tech Mahindra have fallen below the benchmark, and again, when we are buying at a reasonable price compared to the earnings, compared to the OCF, and compared to the free cash flow, that would help us gain more from the increase in the price of these shares. Next valuation ratio is the current market price to book value or price to book value. This is on per share basis. The question we have to ask here is how many times more we are paying against the book value of the stock or the share. The book value is the value of the share as per the company's records. This is what the company is saying its shares are actually worth against what the market participants are saying the shares should be actually worth. TCS per share market price was 2,154, and the company is saying that its shares are actually worth 238 rupees. That is, the market participants have given a multiple of 9 times more than the company's or shares actual price or worth. This is very high. My benchmark as such is that I should buy whenever the price to book value is below 2.5 times. As can be seen, none of these companies are trading below 2.5 times. So what we can do is we can take an average of these companies, 5 companies, and use that as a benchmark to buy into these companies. Many times, good companies would trade at a high premium. That does not mean that we need to buy them at that multiple. Infosys is available at 6.2 times its book value. Wipro is available at a price to book of 2.7 times. HCL Tech is available at 3.5 times, and Tech Mahindra is available at 3.4 times. So the most reasonable seems to be Wipro, which is trading at just 2.7 times its book value. Next valuation ratio is looking at the current market price against the sales. Here too, I have taken the total value of the market cap and the sales. This ratio is not based on per share values. The question we are asking here in this particular chart is how many times more we are paying, or how far away the price is compared to the sales done by the company in the latest year. Regardless of whether we take on a per share based price to sales or in totality, it wouldn't make difference to the multiple. So here we want to pay as less as possible compared to the sales, or the multiple that we are paying should be as near to 1 as possible. That is, if the sales is of 100, the market cap of the company should also be 100. That is what the ratio of 1 indicates. TCS market cap was 8,08,000 crores, against which it did a sales or generated a revenue of 1,50,000 crores. That is a multiple of 5.4 times. That is, the market cap was 5.4 times higher than the sales or revenue it generated. Infosys price to sales was 4.1 times. The most economical was Tech Mahindra, whose market cap was 67,000 crores, against which it generated a sales or generated a revenue of 35,000 crores. That is a 1.9 times multiple. HCL Tech's multiple was 2.3 times. As I mentioned that we want the price to sales to be as near to 1 as possible. This would again indicate that we are paying a reasonable price for the sales generated by these companies. The next valuation ratio we are looking at is Benjamin Graham's formula, price earning multiplied by the price book. This is the product of price earning and price book, and it should not be more than 22.5 times. That is, the price earning should be below 1.5 times, or rather price earning should be below 15 times and price book should be below 1.5 times. This is in contrast to the benchmark I have set for my entry into the shares of these companies. My benchmark for price earning, as I mentioned earlier, was 25 times, and for price book it is 2.5 times. But here, for conservative investor or investor who want to buy at a much lower level, they can select a price earning multiple of 15 and a price book multiple of 1.5. So that would allow them to buy much lower than what my benchmark is set for. So whenever, according to Graham's formula, the product of these two is more than 22.5 times, the stock is more expensive. TCS, the product is 226, and which is way higher than indicated. The price earning is 25 times and the price book is 9 times, and the product of the two is 226. Infosys is also very expensive at 139. Wipro is at 42, HCL Tech is at 50, and Tech Mahindra is at 52. So even here, Wipro, HCL Tech and Tech Mahindra are still very economical compared to Infosys and TCS. This does not mean that these companies are not good. These are just valuation ratios to help us understand how much more or at what price we are buying these shares of these companies. It is just an indication of that. Next, let us look at the growth in net profit over the last 5 and 3 years. TCS has managed to grow its net profit over a period of 5 years at the rate of 10.6%. And in the recent 3 years, the net profit has grown at 9.5%, slightly below the growth rate of last 5 years. So this is good. I want my companies that I'm investing in to grow their profits at least 10% and above. Again, many of these companies' growth rates in profit would depend on the sector that they are in. So we can also use an average of these 5 companies to understand which companies are above the average and which companies are below the average. Or we can use a set benchmark of say 5% or 10%. Infosys growth in profit over the last 5 years was at the rate of 7.5%, and in the recent 3 years the profit growth rate has fallen to 4.2%. So what we want to see is in like HCL Tech, where in 5 years the growth rate was 20%, and in the recent 3 years the profit has grown at a much faster pace of 22%. This indicates that the company's growth in profit has been increasing faster in the recent 3 years. Tech Mahindra's profit growth rate has also increased in the recent 3 years to 12.3% from where it was growing its profits in the last 5 years. Wipro's profits growth rate in profit was very less since last 5 years at 2.9%, against which in the recent 3 years it has seen a further slowdown to 1.1%. Infosys last 5 years growth in profit was 7.5%, and it has seen a further reduction in the growth rate in its profits to 4.2%. So as I mentioned earlier, we want the profits to be growing year on year for both 5 and 3 years at the rate of 10% and more, or at least above the averages of these companies. And also the recent 3 years growth rate should be higher than the last 5 years growth rate. Next, let us look at the PEG ratio of 5 years, that is the price earning to profit growth rate. Here we are looking at the recent 12 months price earning we paid and what is the growth in that earnings over the last 5 years. So when we are paying a certain multiple for the earnings of the company, we also want that earnings to be growing in the last 5 years so that we are assured that we are not paying a very high price earning multiple and we would be able to recover our capital much faster. The PEG ratio helps us understand whether the price that we have paid for the earnings is justified. The way we can justify this price that we are paying for the earnings is by looking at the growth in that earning for which we have paid that multiple. In the last 5 years, the profits has been growing at 10.6% for TCS, against which we have paid a multiple of 25 times the earnings, and that earnings is growing at 10.6%. So we get a PEG of 2.4. Now my benchmark to buy into these companies is a PEG of 1.5 times. Many investors would want to even buy at 1 times. That is, if you are paying 25 times the earnings of the company, the earnings should be growing at 25%. So that would indicate a PEG of 1. like in HCL Tech, where the price earning multiple of the recent 12 months was 14 times, whereas the growth in that earnings was 20%. So it is even higher than the price earning multiple. Therefore, it would reduce the PEG below 1. The current PEG or 5 years PEG is 0.7 for HCL Tech. So this is a very good valuation metric to look at. Tech Mahindra is available at 1.9. That is, the price earning multiple we paid for this company was 15 times, and we are getting a growth rate of 7.6%. So the multiple comes to 1.9. The PEG is calculated by dividing the price earning with the profit growth rate of the last 5 years. Infosys PEG value was 3.1, quite high. Although we are paying below the benchmark of 25 times price earning, we are not getting a very good growth rate in that earnings. Similar is the case for Wipro, where although we are paying 16.2 times, there is no growth in that earnings over the last 5 years. So the PEG is very expensive at 5.7. So this ratio then helps us understand that it is better to buy TCS at 25 times than Wipro at 16 times the price earning, because at least TCS is giving a growth rate of 10.6% over the last 5 years, and we can expect the similar growth rate in the future years. Therefore, the price we paid for TCS becomes more reasonable than buying Wipro at 16 times. So PEG is a very important ratio that all investors should look at. We can also use a PEG of 3 years, that is, compare the recent price earning with the recent profit growth rate over the last 3 years. TCS, although we are paying 25.1 times the earnings, that earnings over a period of 3 years has been growing at 9.5%. Therefore, a PEG of 2.6, again expensive, but when compared to Wipro, it is much better to pay the price of 25 times for TCS than to pay 16 times for Wipro, because Wipro's growth in profits over the recent 3 years has fallen much lower to 1.1%. Infosys is also expensive at 5.4 PEG compared in the recent 3 years. Although you're paying 22 times lower than the TCS, yet the growth in the earnings is just 4.2%. HCL Tech again is available at below 1 PEG, and Tech Mahindra is also available below my benchmark of 1.5 PEG. HCL Tech's earning or price earning multiple we were paying was 14.5 times, and the company's earnings were growing, their profits or the profits were growing at 22.3 times 3% in the recent 3 years. That is a multiple of 0.7. Let's move on to the next chart and look at how the sales has been growing over the last 5 years and since the last 3 years. TCS has been growing its sales over a period of last 5 years at the rate of 12%, which is very good. Even in the recent 3 years, although the sales growth rate has slowed down, it is yet above 10%, which is my benchmark. So this is also good. Infosys has managed a growth rate of 10.5% over a period of 5 years. And in the recent 3 years, the growth rate in sales has reduced, or the rate at which the revenue is generated has reduced by 9.8%. Wipro's Growth rates in sales are also low at 6.3% over a period of 5 years and 4.8% over a period of last 3 years. HCL Tech has seen a very high growth rate in sales over both 5 years and 3 years. In fact, in the recent 3 years, the sales has grown at a faster rate of 24.7%, which is very good. So in all of these companies, HCL Tech has managed to grow not only its profits but also its sales. Tech Mahindra's sales growth rate over the period of last 5 years was 13.1%, which has reduced below 10% in the recent 3 years. The growth rate in sales is a good ratio to look at, as that signifies how well the company's management is able to grow its sales year on year, as that shows the demand for the company's products or services, as in this case. Next, let us look at the return ratios, return on equity over the last 5 years on average, and the return on equity over the latest year or the last year of 2019. The return on equity helps us understand what is the net profit these companies have generated on our money or our investment that we have contributed into the company. So on an average of last 5 years, TCS has returned 34.9% on equity shareholders' money, which is excellent. Even in the latest year of 2019, ROE was 36%. It is not only very high, but it is also above its 5 years average, which shows strength in the return on equity. Infosys return on equity is also very high at 23.6% over the last 5 years. So what I'm trying to understand here when I'm looking at 5 years average is that in 1 year the ROE may get disturbed if the profit is reduced or there is a reduction in profit. But over a period of 5 years, if the ROE is above 15%, then that is a good indicator. Wipro's last 5 years average ROE is 18.7%, again a good value. In fact, if you see, all of these companies have generated a very good profits on shareholders' money. HCL Tech's last 5 years average ROE is 27.2% and Tech Mahindra's is 21.2%. So a overall good ROE for all of these companies. As I mentioned, ROE has to be above 15% for the companies that we want to invest in. The reason that I have used 15% as my benchmark for return on equity is that if I had put the same money into a bank fixed deposit, risk-free, I would get somewhere around 7 to 8% per annum. So in this case, when I'm giving it to the company, there's a lot of risk in the terms of prices falling down, and I'm not getting any dividend out of this investment. So I'm expecting at least double of what I would get from the bank, because I'm taking a higher risk with my capital when I'm giving it to the companies listed in the share market. Next, let us look at the EBIT generated on the fixed assets of the company along with the working capital. Fixed assets are the assets of the company which is tangible as well as intangible assets, and working capital is the difference between the current assets that the company owns and the current liabilities. Current assets and current liabilities are those assets and liabilities which the company has to either sell or clear in case of liabilities in the current year. Let us look at what is the EBIT or earnings before interest and tax these companies have generated on the total or rather on the assets of the company. The formula is given on the right hand top corner. TCS has generated a very high return of 46.0% over the last 5 years on average. The reason why these companies have a very high ROA is because their asset base is very low. So these companies have employed very low assets and are generating huge EBIT against those assets. TCS in the latest year of 2019 has generated 47.7% of ROA, and it is also above its 5 years average. In fact, all of these companies, if we see, have generated a very high return on assets employed into the business. Here too, the return on assets has to be more than 15%. Next, we'll look at what is the net profit generated on the sources of funds these companies have received. The sources of funds are generally net worth or equity plus reserves and any borrowings done by the company in terms of bank loans, debentures and so on. So we want to understand what is the profit or net profit these companies have been generating on the total sources of funds. This is also a very important ratio to look at. So we'll be looking at the 5 years average and then looking at the latest year's ROCE. TCS last 5 years average ROCE is 34.4%, which is again very good. So whatever money the company has received either from shareholders or from external borrowings, on that it is earning 34.4% on average since last 5 years. In fact, all of these companies ROCE is very good over a period of 5 years. Although Wipro and Tech Mahindra is very near to the benchmark of 15%, yet all of these companies are generating good returns. Infosys has generated 23.7%. HCL Tech has generated 26% on the total source of funds. So this is overall very good for all of these companies. Wipro, for that matter, in 2019 has generated below benchmark ROCE. So this needs to be investigated. Next, let us look at the sales turnover on capital employed in the last year. The capital employed, as I explained earlier also, is the total net worth of the company plus any borrowings, and we divide annual sales with the capital employed. Here we are trying to understand how many times more is the sales compared to the capital employed into the business. Sales is represented by orange bar and capital employed is through green bar. The capital employed into the business by TCS was 89,000 crores, against which the company did a sales or generated a revenue of 1,46,000 crores, which is a 1.6 times multiple. So we want the sales to be as high as possible against the capital employed into the business. So this is good. Infosys also had a turnover of 1.3 times. Wipro's turnover was below 1 times. The capital employed was 66,000 crores, against which the company managed a sales generation or a revenue generation of 59,000 crores. HCL Tech's ratio was good. Tech Mahindra's ratio was also good, where it generated more sales against the capital employed. Here we want the sales or revenue to be as high as possible against the capital employed into the business. Next, Let us look at the net profit of 5 years versus the cash coming in from operations in those 5 years. Here we are trying to understand whether the net profit which the company has shown has that actually got converted into the cash. TCS net profit of the last 5 years was 1,26,000 crores. This is the cumulative profits of the 5 years against which the cash coming in to the business through the operating activity is 1,17,000 crores, which is a 7% shortfall of the profit. Here we want to have the cash coming in through operations to be more than the net profit the companies have shown. This basically signifies that whatever profits the companies are showing in their P&L account is actually getting converted into cash. Infosys cash fell short by 19% against the profit declared. Wipro's cash coming in through operating activity was higher than the profit shown, which is 6% higher. HCL Tech's cash was 6% short of the profit, and Tech Mahindra's cash coming in through operations was 8% higher than the profit. So here we want the cash coming in through operations to be higher than the net profit, as that suggests that the company has managed to convert entire profit into cash. In the next chart, we'll look at the cash flow from operations of the 5 years total cumulative versus the free cash flow these companies are holding. Here we are trying to understand, first of all, the cash the company has earned. Out of that, how much was spent on the investing activity, and after spending cash in the investing activity, how much is left over as free cash to be used in the financing activity. So we don't want the companies to be investing a very high amount of cash into assets. TCS cash through operations over the last 5 years was 1,17,000 crores, against which it still has 1,06,000 crores of free cash to be utilized in the financing activity. Financing activity would include bonus, buyback, or acquisition of another company, or even repayment of loans. So all those activities can be done through financing activity. So the usage in the investing was just 9% of the cash. So this is good. We don't want the companies to be spending more than 50% of the cash from operations into buying of assets. A company having a high growth can use the cash into buying of assets, provided those assets are further generating higher profits for the company. If it is not generating higher profits and the company is continuously investing in assets of the company, then that basically would entail that the companies would have to borrow more and more from the external sources. Infosys cash was 57,000 crores, against which 21% of that was used in buying of assets, and the balance 45,000 crores is still left over as free cash. So this is also good. In fact, most of these companies have a good free cash flow when compared to the cash from operations these companies have generated. In this chart, we will look at the net profit of the last year versus how much cash has got converted of that net profit into operating activities or through operating activities. TCS in 2019 showed a net profit of 31,000 crores, against which it received a cash of 28,593 crores through operating activity, which is again a shortfall of 9%. So earlier we looked at the 5-year profit and conversion of profit into cash, and in this chart we are looking at the current year's net profit and how much of that net profit has actually got converted into cash. Here too we want the cash coming in through operating activity to be more than the profits the companies have declared. Infosys cash fell short by 3% over its net profit. Wipro's cash coming in through operating activity was 29% more than the profit the company declared of 9,000 crores. HCL Tech's cash fell short by 10%, and Tech Mahindra's cash came in more by 5% against the profit the company has shown. So as I mentioned earlier, we want the cash from operations to be more than the net profit of the latest year. In this chart, we are trying to look at the growth rate in the current years, or rather the latest 12 months profit over the last 5 years average. TCS last 5 years on average has been earning a profit or a net profit of 25,000 crores, against which in the current 12 months the profit generated is 32,000 crores. So the current 12 months PAT or PAT is above its 5 years average, which shows its strength, which is 27% more than its 5 years average. So we want the current year's profit to be above the average and as high as possible. Infosys current year's profit was 9% higher than its 5 years average, so this is also good. Wipro's profits or recent 12 months profits were also 9% higher than its 5 years average. HCL Tech and Tech Mahindra both have managed a higher current year net profit against their 5 years average by 27% for HCL Tech and 34% for Tech Mahindra. Here we are trying to understand the growth rate in profit from its previous year. That is how the profit has grown from 2018 to 2019. TCS profits in 2018 was 25,000 crores against the profit of 31,000 crore in 2019, which is a growth of 22% over its previous year. This again shows a strength in earnings of the company. Infosys current year profit fell short by 4% over its previous year. Wipro, HCL Tech and Tech Mahindra all have managed a higher profit in 2019 against the 2018 profit. In the previous two charts, we saw how the company has managed to grow its profits year on year and profits over its 5 years average. In this chart, we are looking at the quarterly growth rate in sales and profit from its previous year. TCS in June 2018 to June 2019 generated a higher sales by 11%, and the profit saw a growth rate of 11%, which is good. I generally keep a benchmark of 10% growth rate, but we can also make an average of these 5 companies to understand what is the growth rate in a particular sector. Infosys saw a growth rate in sales by 14%, but the profit saw a 5% growth rate, June 2018 to June 2019 quarter. Wipro's sales grew by just 4%, but the profits increased by 13% over its previous quarter. So we want both the sales and the profits to be growing at least 10% and above. HCL Tech, although sales increased by 18% from its previous quarter, but the profits fell by 8%. So this is a negative. We don't want either the profits or the sales to be going down below its previous year's quarter. Tech Mahindra saw a growth rate of 5% in sales and 7% in its profits. Next, let us look at the net worth of these companies and also compare or look at how much contingent liability these companies have on their net worth. We don't want a very high contingent liability when compared to the net worth. TCS net worth or actual value of the company was 89,000 crores. This is not the market value, but the value of the company when the company's all liabilities are cleared by selling all assets, and whatever remains is the net worth. So 89,000 is after paying all liabilities. The company would still have 89,000 to give it to their shareholders, or this amount would be distributed between the shareholders on liquidation. So this is the actual value of the company, against which its contingent liability was 3,227 crores, which is just 4%. My benchmark is that the contingent liability should not exceed 20% of the net worth. The reason being that contingent liability is a liability which may or may not arise in future, and also contingent liability is not shown anywhere in balance sheet or in financial statements except in the notes to the financial statements, which again increases our risk if the contingent liability exceeds a high portion of the net worth. Infosys contingent liability was just 5% of its net worth. Wipro contingent liability has exceeded my benchmark of 20% on its net worth. So contingent liability could be any liability, like if there is a court case going on against government departments like IT, service tax, and so on, or even if company has given a guarantee on behalf of any of its subsidiaries, those also would come under contingent liability. So this has exceeded my benchmark by 6%. HCL Tech's contingent liability was 0, and Tech Mahindra's contingent liability also exceeded to 27% on its net worth. Next, let us look at the debt to equity ratio We don't want the debt to equity ratio to exceed 1 times. We want the debt portion of the source of funds to be as low as possible against the equity contribution. Here, we are trying to understand, is the company funding its operations through its own funds or borrowed money? And what is the debt burden on these companies? TCS had a very negligible debt of just 62 crores against the equity of 89,000 crores. So the debt to equity is 0. Same is the case for Infosys, Wipro, HCL Tech and Tech Mahindra. So almost all of these companies are debt-free companies against when compared with the equity. Since the debt portion of these companies is very low, let us look at how much debt these companies were carrying 3 years back against the current year's debt. TCS 3 years back debt was 245 crores and they have reduced it now to 62 crores. Infosys was always a debt-free company even 3 years back. Wipro has reduced its debt from where it was 3 years back. 3 years earlier, the company had a total debt of 12,000 crores against the current debt of 9,900 crores. So the company has managed to reduce its debt. HCL Tech has increased its debt from where it was 1 year back, or rather 3 years back. 3 years earlier, the total debt on the company was 1,000 crores against the current debt of 4,195 crores. Although this debt, when compared against the equity that the company has, is very low or negligible. Therefore, even this debt, if they have increased it, it's not a bad thing. Because, as I mentioned earlier, against the equity, it is very low. And sometimes if the company is in a growth stage, then too they would require some kind of external borrowings. Tech Mahindra's debt also grew by around 900 crores, from 1000 to 2000 crores approximately. Again, this too is very low when compared with the equity. As I mentioned earlier, none of these companies have huge debt on them. Therefore, the debt to profit ratio, which we are going to look in right now, would help us understand how much debt these companies are carrying and whether the current year's profit would be able to service this liability. TCS debt was just 62 crores against the profit the company has generated in 2019 of 31,000 crores. Therefore, it can very easily clear off this negligible debt. Infosys is a debt-free company. Wipro's debt was 9,900 crores and the company managed to generate 9,000 crores of profit in 2019. This too can be very easily cleared off using the latest year's net profit value. So we don't want the ratio between how much debt these companies are carrying and how much profits the company has generated to be more than 7 times. HCL Tech's debt was 4,000 and the profit generated in 2019 was 10,000 crores. Again, can be very easily cleared or paid off using the latest year's profit. Same is the case for Tech Mahindra, where its profits were almost twice of the borrowings the company has done. Next, let us look at the interest coverage ratio. This is the EBIT these companies are generated, and against the EBIT how much the company is paying as interest cost. So this will help us understand whether the company can take care of its service or interest obligation using the EBIT it is generating. EBIT in this case is earnings before interest and tax. TCS earnings before interest and tax, or EBIT, is 41,000 crores against the current interest cost of 198 crores, which is very negligible and can be paid off very easily. In fact, the ratio between the two, or the multiple between the two, is 97 times, which signifies that the EBIT, or the operating profit, or the top line profit this company has generated is 97 times more than what it has to pay as interest cost. Infosys is a debt-free company again, so there is no use or no need to look at the multiple. Wipro's multiple or coverage is 17 times, and as we saw earlier, 12,000 crores of EBIT generated, against which it had to pay just 738 CR of interest cost, which is 17 times more. HCL Tech's EBIT is 52 times more than the interest paid in 2019, and Tech Mahindra's multiple was 39 times. So all of these companies are in a very good position to pay off their interest cost using the EBIT these companies are generating. Next, let us look at the promoter holdings of these companies, how much stake the promoters have in the company, and what is the pledge, if any, done by the promoters. TCS promoters are holding a high stake into the company, which would then mean that the business that these companies have will be run well, because the management's stake itself is huge. And the management has pledged 3% of their shareholding, which is low. My benchmark is that promoters' pledge should not cross more than 20% of their holdings. Infosys promoters hold a mere 13% into the company. Again, we want the promoters' stake to be more than 30% in the company, as that would, as I earlier mentioned, give us a safety margin as well. None of these companies' promoters have pledged any of their shares except for TCS. Wipro, HCL Tech both have a high promoter holding, and Tech Mahindra's promoter holding is 36%. Let us look at the raw material cost as a percentage of sales. Here we are trying to look at how the company is managing its raw material cost. TCS, and in fact all of these companies, since they are into service sector, providing services, these companies don't have a major raw material cost. So we will skip this particular ratio. Next, let us look at the debtors of these companies and what portion of the sales they are occupying as of 2019. That is, in this ratio we are trying to understand how much payment is still pending to be collected from the customers against the current year's sales. TCS did a revenue generation of 1,46,000 crores in 2019, against which the total customers from whom the company still has to collect payment, that is trade receivables or account receivables, or also known as debtors, were 27,000 crores, which is 18.2%. According to my benchmark, I don't want the debtors still pending to be collected till 2019 to exceed 30% of the total revenue generated in 2019. So this value is alright. Infosys too has managed to keep its debtors at 18.5% of its total revenue generated in 2019. So is the case with all the other three companies which have kept it within a range of 16 to 20%. When the companies are collecting payment from their customers on time, then that would reflect in efficiency of the management. Next, let us look at the debtors to sales which we saw earlier and compare that as to how many days these companies require or are taking to collect payment from their customers. This is again an efficiency with which these companies are collecting payment from their customers. So the faster these companies collect payment from customers, the better it is. TCS, we saw earlier, the total debtors still pending to be collected were 18.2% of the current year's sales, against which it is taking 68 days indicated in orange bar in the 2019, and 3 years earlier it was taking 81 days to collect payment from the customers. So now this is reduced in 2019. So this is a good sign, and also the debtors are very small compared to the sales these companies are doing. Infosys too has reduced or managed to reduce 1 day in 2019 compared to the collection period 3 years earlier. In fact, Wipro too has reduced from 71 days, which it was taking to collect payment 3 years earlier, to 62 days. Similar is the case for HCL Tech and Tech Mahindra as well. Their debtor days have reduced from 80 to 73 days. So the faster the company is able to collect payment from the customers, the better it is for their working capital requirement. In this particular ratio, we are looking at the debtors to creditors ratio. That is how much payment the company has to collect from their customers vis-a-vis how much they have to pay back to their suppliers for the credit purchases. So here, if the company gets a high creditors or credit days to pay to their suppliers compared to how much days it is giving to its own customers, it shows that the suppliers are willing to give credit to this company. If more creditors are willing to give credit, it also shows reputation in the market. Not necessarily, but in general. TCS, total customers from whom the company has to collect payment, is 27,000 crores against 6,500 crores it has to pay to its own suppliers from whom it had purchased on credit. So this is 20% of the payment it has to collect. So the company is very efficient in paying back to its suppliers. But we saw earlier, even this 27,000 crores that it has to collect from its customers is still negligible when compared to the current year's sales. So the ratio overall is very good. If the creditor's value was higher than the debtor's value, that too would indicate that customer or suppliers rather are willing to give credit to the company. In fact, all of these companies' ratio of debtors to creditors is very good. In this chart, we are looking at the average operating profit margin of the last 5 years that these companies are generating and comparing that with the latest NPM and NPM of the preceding year. NPM is the net profit margin these companies are generating in 2018 and 2019. TCS OPM of the last 5 years on average was 27%. This is very high. My benchmark is that companies should be earning an OPM of at least 15% and higher, because out of that 15% of the top line profit, we still have interest cost, depreciation, tax, any exceptional or extraordinary losses to be deducted to come to our NPM level of 10%. Therefore, whenever company's OPM falls below 15%, that needs to be investigated. So all of these companies' operating profit margin is above 15%, and even the net profit margin of both 2019 indicated in orange and net profit margin of 2018 indicated in blue are all above 10%. So all of these companies are very efficient in generating return on sales. Next, let us look at the working capital requirements of these companies and the current ratio generated when we divide current assets by current liabilities. This is a liquidity ratio which helps us understand whether current liabilities can pay off the current assets. In this case, current liabilities are those liabilities which needs to be paid within 1 year or current year, vis-a-vis the current assets which can be sold in the current year. So is the company in a position to clear or service its current liabilities requirements using the current assets? All of these companies' working capital requirement is in positive, meaning their current assets are high enough to pay off the current liabilities by more than 2 times, except for Tech Mahindra, whose, although even still better, is below 2 times at 1.8. That is, the current assets were 15,696 CR against 8,656 CR it has to pay as current liabilities. Next, let us look at the gross block. This is the total assets of the company at its acquisition cost. And when we remove total depreciation deducted till date from this gross block, we get net block. So here in this chart, we are trying to understand of the total assets the company has at its acquisition cost, how much of the total depreciation has already been deducted and transferred to the P&L account, and how much more is left over to be deducted in the future years. TCS total assets still to be depreciated over the future years is 26,965 crores. This is the complete assets of the company which still haven't got completely depreciated or expensed out to P&L account. Out of that, the 14,675 CR has already been depreciated. That is 54% of the total assets are already depreciated, meaning 14,675 crores has been transferred to P&L account as expenses, as depreciation expenses in the past years. Now the balance of the 26,965 CR has to be transferred in the future years. So this is good. We want the accumulated depreciation to be as high as possible, as that would suggest to us that in the future years the depreciation cost as such wouldn't be a big expense on the P&L account. In fact, even for Infosys, Wipro and Tech Mahindra all have a above 35% of accumulated depreciation on their total gross block. The highest assets was with HCL Tech of 30,730 CR. Of that, 7,800 has already been depreciated. So the balance 20, that is 26% has been depreciated. Anything above 25% is a good value to look at, and the balance of the 30,000 has to be still transferred to the P&L account. So we will be seeing depreciation as an expense on the P&L account for the future years in HCL Tech. So it is going to form a part of the P&L account. Now let us look at in the next chart what is the depreciation these companies are transferring every year as expenses to P&L account. So this will give us an idea as to what kind of expenses we should expect in the future years as well from these companies. Anyways, these companies' profits are huge compared to the depreciation that they are transferring to the P&L account. So let us go to the TCS first. TCS total assets as of today, after removing all the accumulated depreciation we saw earlier from the gross block, we get the net block, which is 12,290 CR. This is the total assets the company has after accounting for all depreciation. Now only 12,290 CR is left over to be depreciated or transferred to the P&L account as expenses in the future years. In 2019, company transferred 2,056 CR as expenses to P&L account, which is 17% of the net block. So this is good. Anything above 10% is a good value. In fact, when we look at the average of these companies, we can take that as a benchmark for us. Infosys also has transferred 10% of its net block to the P&L account. Wipro's depreciation is also similar to the previous two companies. In fact, all of these companies, still HCL Tech, they're all transferring around 2,000 CR or so to the P&L account. Tech Mahindra has transferred 1,100 crores as depreciation expenses to P&L account in 2019. And its total net block also is very less at 7,060 crores. So accordingly, it is transferring around 16% of depreciation to the P&L account. Now what happens is, if the company is transferring a big portion of the net block as depreciation cost to the P&L account, then that will reduce the profit that the companies are showing every year. And the other way, if the company is showing less depreciation expenses to P&L account, then the net profit will increase. So we have to see a balance, or rather, even if the depreciation being transferred to P&L is high, it is still better than a low depreciation being transferred to P&L account. Finally, let us look at the cash these companies are holding as a percentage of the market cap of these companies. TCS total market cap was around 8 lakh crores. Of that, the cash holding of the company is only 12,000 crores. So it is very marginal. We don't want the companies to hold a huge amount of cash, as that would be basically cash lying idle in the bank account. Rather, we would want the companies to invest this cash in some kind of, either in the back into the business to grow the business, or invest in some kind of investing activity like buying mutual funds, or investing in mutual funds, or investing in subsidiaries, and so on, or giving out as loan, so the company can earn other income out of this cash lying idle in the bank. In fact, all of these companies cash holding is below 1% as of the market cap when compared with the market cap. So this concludes my analysis of these software large cap companies. Now I'll give it a score, and then we will try to understand which of these companies are ranking the best in terms of all different ratios that we have analyzed in the graphs. To understand how these companies have done in terms of different ratios, I have given them score from 1 to 5. There is no negative marking in this particular scoring system. Here, by way of example, let us look at price to earnings ratio. The ratio here we want it to be as low as possible. So the ratio, or the company which has the highest price earning ratio, would get the lowest score. In this case, TCS has the highest price earning ratio of the 12 months. So it has got the lowest score, followed by Infosys, available at 22 times, and Tech Mahindra and HCL Tech both are available at the lowest price earning multiple, so they've got the highest score. In a similar fashion, all ratios which are giving the best score are getting the highest value. I won't be going through all of these ratios again, as I've already covered them in the previous graph analysis. Here I'll just skip this chart for 5 seconds each till I complete all the ratios. So anyone interested in looking at the numbers as such can note down these values, or pause the video and look at these values. Okay, finally I have grouped all of these somewhere around 40 to 60 ratios into different metrics, or grouped them under different headings: efficiency, cash flow, growth matrix, return matrix, solvency matrix, and valuation matrix. Each metric has different ratios combined together to give a score, a single score. So for example, in the efficiency metric, I've covered, or I've included, asset turnover ratio, contingent liability to net worth ratio, debt to equity ratio, interest coverage ratio, the debt to profit ratio. These different ratios helps us understand how efficiently the company has managed to turn over, for example, its assets into sales, and how well it is managing its contingent liability against the net worth of the company. what is the debt of the company, how much debt it has taken up against the equity. So again, it shows efficiency, the lower the better. Interest coverage, can it pay its interest efficiently using the EBIT it is generating? Then for debt to profit, how far away or how much is the debt compared to the profits that the company is generating every year? Again, compared to the sales of the current year, how much is still to be collected from the customers? And so on. So it shows a kind of an efficiency in these ratios. The cash flow ratio metric includes CFO to PAT 5 years, which suggests how much of the profit these companies have generated in 5 years has got converted into cash. And then how much of this cash of the 5 years is still left over as free cash flow. And also of the latest year, how much profit the company managed to convert into cash. In terms of growth metrics, we are looking at how the company is managing to grow its sales over a period of 5 years and in recent 3 years, both sales and profit. Then what is the growth rate in return on equity? Is the ROE over the period of 5 years increasing or decreasing? Then how much is the profit increased over its 5 years average? So that again gives us an idea as to whether the profit is increasing above the average, and that shows a kind of better management efficiency. Also, we'll look at what is the growth rate in profit year on year, that is from 2018 to 2019. All of these ratios have been included in the growth metrics. I've also included the growth of sales and profit quarter on quarter as well as YOY. And then finally we'll look at what is the net worth of these companies. In written metrics, we are looking at the profitability that these companies are generating on different sources of funds. So we have what is the profit the company has generated on equity over the period of 5 years in the latest year. What is the profit the companies have generated on the capital employed for both 5 years average as well as the current year? What is the profit generated on the assets? What is the OPM? What is the NPM? And so on. Solvency metrics includes the promoter shareholding, how much if the promoters have pledged any shares, the current ratio, and finally the valuation ratio, which includes the price earning comparison, price to OCF comparison, free cash flow comparison with price to book value comparison, price to sales comparison, and finally the PEG, which is also very important to connect it with the price earning ratio. So here I have given the efficiency metric the highest weightage of 6, and I'll be multiplying this weightage with the total ratio score of 37. So we have 222. Similarly, I have multiplied cash flow metric has been given the weightage of 5. So I multiplied 5 with 9. 9 is the total ratio value of the individual scores. And then I've given it a weightage of 5. So it's 45 score for TCS. And so on till a valuation metric which has been given the lowest weightage. So TCS is the most expensive as such and has got the lowest score of 19. So I multiplied 19 with a weightage of 1. Similarly, Infosys also is very expensive at a weightage of 30. So the lower this value, more expensive the stock is. The higher the value, the better it is for all of the metrics. So the higher the score any metrics has received, it means it has the best ratios for that particular metrics. So in this fashion, I have completed my analysis. TCS, even though it is the most expensive in terms of valuation, it has got the first rank because it has done very well in efficiency, in growth, in written metrics, in solvency, Although it is expensive and is the most expensive of the group companies, it still got the first rank. Infosys has got the second rank. It is also very expensive, yet in terms of efficiency as well as written metrics, it has got the highest score. In terms of cash flow and growth rate, it has got the second lowest score. The Wipro has got the lowest ranking of the 5 companies at 428 points, followed very nearby with Tech Mahindra at 437 points. They are the most value-wise. HCL Tech and Tech Mahindra is available at the best valuations in the group company, but their efficiency for Tech Mahindra is the lowest. HCL Tech has the lowest cash flow metric ratios. In terms of written metric, Tech Mahindra has got the lowest score. Even in terms of solvency, it has got the lowest score along with Infosys. And this concludes my analysis of these companies. If you have still been watching this video up till now, after more than 1 hour, I would appeal to you to subscribe to the channel so that in case I release more videos, you will get a notification for that. Thank you for watching this video.